Are you a self-employed borrower? Or maybe you might be in the future? So this module is one of my favorite because the self-employed borrower thinks by not showing a lot of income that that's a permanent problem. But I'm here to show you that there's many different ways we can get loans for self-employed borrowers, along with educating on the proper amount of money to show from an income perspective to qualify. So self-employed borrowers, it's just temporary. We can make sure that you get loans too and own the real estate that you need to own. One of the biggest groups that I have to help is self-employed borrowers, right? There's so many solutions for self-employed borrowers, and it's sort of like credit. Like a lot of self-employed people think they're in a permanent state of, I don't show enough income. Well, that's a pretty easy solution. Let's show more income. But there's other ways that we can bridge the gap for self-employed borrowers. So I have a question for you. Who's the most cheated on guy in America? Pretty simple answer. It's Uncle Sam. And I'm going to explain why. So self-employed borrowers, let's talk about a psychology really quickly. And also it segues into my coaching course when I teach people how to own multiple pieces of real estate, because everybody believes that they're, listen, because Uncle Sam is the most cheated on guy in America, all of you self-employed borrowers are trying to not pay him. I get it, right? And sometimes you don't even realize you might bring in $400,000 or $500,000 or $2 million into your business, and you don't really know what your CPA claims because you're not an accountant. All you know is the number that he gives you or she gives you on what you owe the government at the end of the year. And some of you pay quarterly or whatever. But a lot of plumbers, electricians, carpenters, people that own their own small businesses do a very good job of avoiding taxes. But I always say this, guys, you can't cheat the government and then get a government loan. Remember, we talked about Fannie, Freddie, FHA are owned by the government. So you kind of can't cheat the IRS and then qualify for a loan. But you also don't want to put yourself in a permanent state of having interest rates a lot higher than the market, right? So how do we create that solution? You don't always have to show nothing. So for self-employed borrowers, we're talking about, not having to show nothing. And this could be 1099 employees such as realtors. But the question is, how do we become fundable and how do we stay fundable, right? Because sometimes you don't have to claim as much as you think you have to claim, but it's how do we become fundable and stay fundable? So let's talk about some of the products. For self-employed borrowers, did you know that if you're self-employed for 5 years or more, we can use the most recent year tax return? So say, for example, 2022, you only showed, $60,000, but you need to show $100,000 to qualify for a mortgage. The right mortgage company can explain to you what you need to make in order to qualify. By the way, back to the debt to income ratio slides, you can calculate it yourself, but if you're self-employed, you have to go by the net number on the bottom of your tax returns, not the gross number. Now, if you're self-employed for 5 years, there's a 1-year tax return product. Wonderful. So you showed 60 last year, you show 100 now, you qualify for the mortgage. That's wonderful. Number 2, we do have a 12-month and a 24-month bank statement product, which is the following. We take, say it's a 12-month, we take 12 months of deposits into your bank account in your business, and whatever that gross number is, we use half to allow you to qualify for debt to income. Example, you bring in $400,000 a year to the business, we get to use $200,000, and if you make $200,000 a year divided by 12 months, whatever that is, $14,000 a month or whatever it is, then your debt to income ratio goes off of that. Now, that interest rate is 2 to 3 points higher than if you prove income on your tax returns. So we have to balance, you have to learn how to balance between, do I pay the government a little extra money, right? Because now I got an interest rate that's almost 3 points better, which is going to save me a ton of money over the life of the loan. So you have to weigh those options. Now, if you're an investor, we have a whole investor course. There's a product called DSCR, Debt Service coverage ratio. With the DSCR loan, if you put 20% down, if the property has cash flow, mortgage is $3,000, rent's at $3,300, whatever the number, if it has cash flow, you could borrow money. So the DSCR, you don't need tax returns for an investor only, not owner occupied. But it's 20% down, and once again, the rates are significantly higher, probably 3% higher. And a lot of flippers, real estate investors, wholesalers, they'll borrow hard money, right? Fix up a property and then refinance after. In my coaching course, I have something that shows people how to buy with hard money, how to use that to fix up the property. You still have to come up with like 20% of your own money. But then after 6 months of owning the property, we could actually give a cash out refinance. And a lot of times if it has a new value, give you your money back. And then if you show the right amount of money on your tax returns, you can get a conventional investor loan. That's heavy duty stuff. I told you enough about that now. We could talk about that more in the future. But to recap, 1 year tax return, 12 or 24 month bank statement, DSCR for investors, or hard money. There's a lot of solutions out there, but definitely the best interest rate is if we help you show the proper amount to qualify.